Hello and welcome to Creditversio's Q&A Wednesday live for July 7th. I'm your host, David Michalek. I'm a consumer credit expert with almost 9 years experience focused on credit repair and credit education. I've conducted over 10,000 one-on-one credit consultations, which resulted in over 1 million disputes and tens of thousands of accurate accounts being deleted from credit reports. So I'm looking forward to sharing with you what I've learned on our live weekly Q&A calls. We do this every Wednesday at 6 p.m. Eastern Time. We do this on both Facebook and our YouTube channels. Thank you so much for joining me. Please take a second, introduce yourself, and we'll get started here in just a moment. As I'm sure you know, and this is the reason why we're here today, our credit report and scores play an enormous role in so many areas of our lives. When we have insurance companies, landlords, mortgage brokers, banks, even our employers are looking at our credit reports to see how we honor our obligations. Now, when that happens, you can see why our credit reports are so important. Having great credit is mandatory because credit reports are adult report cards, and they tell the story of what we do when someone or a company entrusts us with credit. So that's why we do these weekly live Q&A sessions. So again, welcome. Please take a second, introduce yourself, let me know where you're from, and if this is your first time joining us. All right, got Scotty. Love seeing the regulars. Scotty, thank you for joining me again. So today is going to be fun. We're going to, not that they all aren't fun. We don't have John with us today, but what that does, it gives us a little bit more freedom to talk more about the credit repair aspect of what we're doing. John, as you know, he is the #1 credit expert in the country, but he doesn't really focus too much on the credit repair side. And so when I'm by myself today, I get to answer all of those questions. Largely what I do is answer questions that we get during the week. Mostly they come directly from Facebook and direct messenger. And it's a lot of questions week after week, and I like to put them on the live so we can just discuss them together. So today what I'm going to be talking about, a couple of subjects. You probably saw it in the description. And this is based on probably 4 or 5 questions that I've just gotten in the last maybe 2 days or so, is understanding the difference between credit reports and credit scores. So we're going to be talking about that today. And while we're doing that, it's perfectly fine for you to jump in and just post some questions if you have them. I'll stop what I'm doing, answer the question, so don't be shy. Now, it's perfectly fine if the question isn't related to what I'm talking about. Again, everybody that was invited today, apart from the regulars, we have a lot of new people who signed up for Creditversio that are with us. And if you have any questions about how to use the software, about the dispute process, anything at all, please just let me know, and I'm happy to answer those questions for you. Okay. The first thing I'm going to cover today is the difference between a credit report and a credit score. Now, believe it or not, they're 2 entirely different things. Let me give you a great example. Or, in fact, let me back up a little bit. Let me tell you how credit reports are generated. Contrary to a lot of popular belief, you and I don't have a credit report in the cloud somewhere just waiting for a creditor to go grab it. It doesn't really work that way. There's about 16,000 data furnishers. You can call them creditors, but a data furnisher is any company that supplies information to the credit bureaus. It could be a credit card company. It could be a credit union, your bank, Ford Motor Credit. It can be Capital One. Anybody who is supplying information to the credit bureaus. Typically, they do this on a monthly basis. It depends. There's no strict requirement that says that they have to provide data at any interval. Sometimes data furnishers don't supply data to all 3. Sometimes they pick 1 or 2 bureaus. Sometimes they don't report at all. In some cases, they don't report unless you're late on something, which is often the case with, say, utilities. They don't report unless you have some kind of a self-reported service like Boost, Experian Boost. But largely, when the information is supplied to the credit bureaus, it's just data. It's just code. And it just sits there. Think of like a huge pool of ones and zeros that's just sitting there. Billions and billions of bits of data that's being stored at Experian, Equifax, and TransUnion. So let's use a car dealership as an example. Say I go into a car dealership, I'm going to buy a car, and of course they're going to run my credit. I fill out all the information, full name, address, social, date of birth, and in that information that I supply is something called PII. It's personally identifiable information. And when that application goes over, or that information goes over to the credit bureau through the computer that's being used by F&I, if I'm using this car dealership example, what happens is all that information, my personal information, goes over to the credit bureaus, and at that very moment, it takes a lot of snippets of my information, the PII, the personally identifiable information, and it dives into that big pool of data and starts to build my credit report. So it'll go, oh, okay, this is David's information here. This is from Capital One. This is from VW. And it'll assemble my credit report right there in real time. And this happens in a matter of milliseconds. And then that is returned back to the person that requested the credit report. Now, the reason why I'm explaining this is the credit report at that moment in time is completely absent of a score. Scores are not necessarily, they're not generated at the credit bureau level. And what I mean by that is Experian is not creating your score. Your score is being created by Fico or VantageScore based on the data that is being provided by Experian, Equifax, and TransUnion. So when that credit report comes over in that car dealership example, it's going to be assessed using most likely anyway, not always, but most likely it's going to be assessed using an auto-specific, it's called an industry-specific score, probably a FICO score, better than a 85-90% chance that that's what they're going to use. It's just because it's an established score. It's been around for a long, long time. It's very possible they might use a VantageScore. You don't know. So when that report comes in, it's going to be scanned and a score is going to be given to my credit report at that moment in time. So this poses a couple of very interesting tidbits of information that I want to break down for you. First of all, again, as I said, credit reports are completely separate from a score. And if you want verification of this, try going to annualcreditreport.com. So that's a federally mandated website. It's actually owned under a separate LLC by all three credit bureaus. This was required under what's called FACTA. That's the Fair and Accurate Credit Transaction Act. That was written in 2003. And that's why you and I can go get a free credit report. Now, it used to be once a year, hence the annualcreditreport.com. But because of COVID, we can get, I believe it's a report every week, or it might be every other week until April of 2022. Now, when you get that credit report, does it come with a score? No, it does not. That's because it's a completely separate component. And VantageScore, which is owned by the three bureaus, and FICO, which is its own separate company, these are accessory items that go on top of a credit report. And nobody is going to pay to give you on annualcreditreport.com anyway, to give you a FICO score or a Vantage score. That's why you're just getting pure data. Okay, so that is probably the best example that I can give you to explain why credit reports and credit scores are separate. Now, there's a couple reasons why this matters. Going back to what I said a second ago, that you don't have a credit report just waiting in the cloud for you, that's just sitting there for somebody to go grab. Credit reports are called queries, meaning they don't exist until the moment that they are created. So if I go to that car dealership or a mortgage broker, or I'm applying for a credit card, or for example, maybe my employer wants to pull a credit report. Now, they don't get credit scores, but maybe they want to pull my credit report to see what I'm up to. Maybe I'm going to go into a job where I need a security clearance. John and I were talking about this last week, where one of the conversations that I used to have a lot when I would enroll people in the credit repair and educational side was, People would call up because they're getting ready to get a promotion. They work for the Department of Justice or the FBI or the CIA, Homeland Security, and they knew they were not going to be able to pass their background check. They usually got a little heads up because maybe they had some collections or a charge off or something that they had to deal with in some way or another. So when you get a credit report, it's valid, it's accurate for that moment in time. And then, same thing with the score. When that credit report comes in, whether it's from Smart Credit, Identity IQ, MyFICO.com, Credit Karma, it doesn't matter. That credit report is a moment in time. It's a flash of time. And same thing with that credit score. It could be different tomorrow. So what would make that change? Your data furnishers, your creditors. Let's say you get a credit report on a Tuesday and your score on Experian, just making it up, is 740. And then on Wednesday, another creditor reports that you've got a higher, your utilization rate went up, say, from 20% to 80%. You pull a credit report on Thursday. Now your credit score is 710. So this is how credit reports and credit scores are different and separate. So I get a lot of questions. In fact, I got one about 4 or 5 hours ago with somebody sending me screenshots of, hey, my Credit Karma score is different than what my Crediversio score is. Well, the Crediversio report and score was from 2 weeks ago. So they got another 20 days or so until their new credit report comes in. So what that individual was seeing was movement that's taking place. Now, this is aside from the fact that that the way the scores are calculated might be different. The reason for that is the bureaus calculate scores differently. They have their own slightly different formulas of FICO and also slightly different formulas of Vantage. So even if all the information is the same across your credit report, the same across the board, because the bureaus have slightly different versions of every scoring model, you're still never going to, it's very, very rare to get the same score. For as many credit reports as I've looked at, I mean, probably 15, 20,000 or more, I could probably count the times on the palm of both my hands how many times I've seen the same credit score across all three bureaus. It's incredibly rare. So what that person was seeing, just to recap, is that they were pulling a credit report from Credit Karma on a different day with different information, and especially during the dispute process. And what that means is there's a lot of changes going on with that credit report, and that would explain why scores are moving up and down as they do. Okay, so that's the difference between reports and scores. If you have any questions on that, feel free to let me know. And then we'll move on to the next subject, which is FICO versus VantageScore. And this one, it seems like almost all the questions that I get, or got this week anyway, were about the difference between reports and scores, and then FICO and VantageScore. So one thing that you have to keep in mind when we're talking about credit scores is that FICO has done an incredible job at branding their scores. When people say, what's my credit score? They typically will say, well, what's my FICO score? It's just like if I'm dating myself a little bit. This is not language that's used as much anymore. But you used to say, let's make a Xerox copy of something. Well, Xerox is the name of the company. But they became so synonymous with photocopies that people would say, well, Xerox me a copy, even though there's Sharp and Brother and a ton of other companies that do the same thing. So FICO has really established themselves in that place as well, to the point where FICO onto itself is associated with the only score that there is, or that's what people believe. So what's this Vantage score? How can we see Vantage scores? Vantage scores are what you're going to see on Smart Credit, Identity IQ. A lot of the free scores that you get are likely going to be Vantage score, not all the time. Sometimes you'll get a FICO score. Credit Karma is another one where you're going to see a VantageScore. So what's the difference between the two? Well, FICO has a very, very, they have a deep history in the scoring place. FICO was created in 1956. They've been creating scores ever since then. Now, the bureaus adopted FICO scores in 1989. In fact, when if you guys have been on with me before, you've seen John Alzheimer was part of that team that integrated FICO scores with bureaus, specifically with he went on to Equifax afterwards, which is why he's got so much knowledge on that transition. And with FICO, what they did that's very interesting, and this is not something that VantageScore does, is that FICO created what are called industry-specific scores. So a long time ago, if you were a big bank or big lender and you knew what your metrics were, you knew you had a lot of data on your clients, and you wanted to build a scoring model, you could take that information to FICO and say, okay, this is what we understand about our clients. And FICO would engineer a score specific for your industry. Case in point, the only FICO score that can be used for mortgage is the mortgage FICO score. It's the oldest score they've got. It's about 20 years old now. And because of FHFA, they mandate that only that score can be used. And the reason for that, and again, we can argue all day if this is really a good idea, because certainly there's a strong argument that VantageScore, the newer Vantage scores, are better and more predictive than what that old FICO score is. But when you have something that is in place and has been in place that long and is mandated by the government, it's hard to make that change. But that's a great example of an industry-specific score. The FICO 8 score that we see. So if you go to, like, on my Experian app on my phone, when I pull up my score, I'm seeing a FICO Model 8 score. So who uses that score? Not many people. Some credit cards are usually the biggest user of Model 8. VantageScore is a very interesting story. It's been around since 2006, and that was the bureau's attempt at taking market share from FICO. In fact, it's kind of an interesting story. The short version is that the bureaus band together and they hired a big outside consulting firm, and they said, listen, we're paying FICO for scores, but we own the data. What would happen if we created our own scores? If we created something completely new that we offered and we can control? And the outside company, the consultants, told them, well, you would have 100% of the market share within a couple of years. So that didn't happen, clearly. They created VantageScore. That was 2006. And today, FICO still has about 90%. It's slightly dropping because VantageScore is becoming more ubiquitous. Lenders are recognizing that is a very, very good predictive scoring model. So it's becoming more and more of a standard rather than something that's on the fringe. So largely, the question that I'm looking to answer, that I get a lot about FICO scores and Vantage scores, is, well, what's the real score? Well, and it's almost like asking, well, listen, Ford makes a car and Chevy makes a car, but what's the real car? Well, they're both real. They're just different. So sometimes you'll see big swings in score or big differences between FICO scores and Vantage scores. Sometimes it's a little bit, sometimes it's a lot. Occasionally you'll see your Vantage score higher, sometimes it's lower. So there really isn't any like conversion. I saw this recently where somebody had a website that said, get your FICO Vantage conversion. This idea that you could put in your Vantage score and it would tell you what your FICO score would be, which is complete nonsense. It doesn't work that way. There are far too many variables to consider that. Okay, so on FICO and Vantage, again, not to drag this out too much, but the important part is understand that both of them are accurate scores. Both of them do the same job of predicting risk, and both of them can be used by a lender. And when you go in to apply, it's possible that you will not know what kind of score they're going to use. They might use a FICO. Now, again, the exception to the rule is going to be a mortgage. But apart from that, if you go into a car dealership, chances are it's going to be FICO, but it might not be. If you are getting a credit card, it could go either way. Chances are it's going to be FICO. It's a good chance it could be VantageScore. I've seen both. So just be prepared that don't go into any kind of scoring situation thinking that, well, one score is my real score. It's not the case. Okay, any questions on scores? I know that I'm covering a lot of material. I'm covering it pretty quickly. If you have any questions on that, please feel free to jump in. And then from here, again, inquiries is always a subject that I can talk about. I got 2 questions today about inquiries that really have to address the significance of inquiries. And it looks like I've got one question here from Johnson the Queen. I remember you from last time. Okay. I pre-qualified for Capital One Auto Finance. However, why are the car dealerships still want to run my credit through their finance company? I already know my approval with Capital One through their navigator. Yeah. Okay. So great question. I got this a lot. In another lifetime ago, I used to be an F&I manager for Saturn. If we all remember the Saturn car brand, unfortunately, they went the way of the dinosaur. But in order to do that, you had to be a GM F&I person. Now, the reason why they're gonna do a quick application is you're gonna drive off that lot. Now, unless you walk into the dealership and let me know, Johnson, if this is the case. Unless you walk into the dealership with a check, they still have to give you a temporary approval. So they have to make sure that you can qualify for this. And the reason for that is if you're going to bring them, I forgot the name of the contract. Oh, it's called an option contract. So when you go into buy a car and you have a pre-approval, usually you just have a letter. So they're not going to let you drive off with that car with a letter. Again, cashier's check is a bank check is the only thing that you can give them that's going to prevent that. Or if you do a wire, that didn't really so much exist back when I was in F&I. But apart from that car being paid for in full on the spot, they want to make sure that they can verify that you've got the credit and that this approval that you have with this other company is legitimate. Because you're driving off with what, a $20,000, $30,000, $50,000 car. So that's why they're going to do that option contract. So when you do, if you haven't done it already, Johnson, what you're going to see when you buy that car is it'll say alternate financing at the bottom. And now they might have changed this since. Like I said, it's been a long time. But the way it used to work is you'd have a box that would say option contract. You have 7 to 10 days to bring in full payment from, and they'll usually write in or type in on the I'm talking about the big sales contract. It'll say you've got X amount of days to bring in full payment from this other provider. In your case, I think you said it was Capital One. And if you don't in that contract, and again, this is why they run that credit. If for whatever reason you don't show up, or maybe they gave you a better deal, because remember, they make a lot of their money on financing that vehicle. So they get a big kickback. Let's just say you're with Toyota. So Toyota Motor Credit gives that dealership quite a kickback for financing that car. It's a pretty known rule of thumb that in the auto industry, there's not a lot of money that's made on selling the new car itself. It's all in used cars, service, and financing. So that's the other reason why they're running that credit report, Johnson, is they want to see that if you don't come back, or if they can beat that interest rate from Capital One, they're going to try to do it right there. And if you don't show up, you agree that whatever financing they gave you is going to go into effect, because that dealership's going to be paid for that car. Okay. Scott with a question. I paid off my credit cards. My car is about to be paid off. Could hurt my score. Maybe, Scott, it depends. If that's your only installment loan, you might see a temporary drop. The only debt I have left is my home. Let me put that back up. My score just doesn't seem to move much. Would you get another card? Would getting another card really help because I get dozens of emails a week telling me so? Also, can you tell me if joining a credit union helps? Okay, so let me just put that back up there in case somebody didn't get a chance to read that. You know, Scott, really all you need is there's a couple of boxes that you need to check. One for an installment loan and one for a revolving account. Now, the benefit of having multiple revolving accounts is you increase your amount of credit. Credit scores can be very sensitive to utilization rate. So if you carry balances on credit cards, and I think you've been to a couple of these already, you know that we've talked about utilization rate and what it can do to your credit. Do you need another credit card? Probably not. Where are your scores stuck? If you do pay off your auto loan, you still get credit for having that installment loan. That's perfectly fine. Yeah, you might see a little bit of a drop. You do get credit for things that you're actively paying on. That doesn't mean go out and get another installment loan, of course. But I would look at your utilization rate. How old is your credit? How old's your oldest account? What's the age of your average account? Are you new to credit? Case in point for me, I say this all the time. I got into the credit repair industry as a client back in 2012. So I had really, really great credit all through my 20s and 30s until the Great Recession, and then everything came crashing down. And I've said this, I told the story many times. I was one of those guys that had little too leveraged, and especially in real estate. So when I came back and entered the credit scene again, I had to start from scratch. So rather than me having a 20-year history of real estate, well, maybe not 20 years when I bought my first house. No, actually, yeah, 20 years. I was 29 years old when I bought my first house, almost 30. So all of that's gone. So I had to start from scratch. So rather than my average age of account being 15 years, or my oldest account being 20 years, my oldest account started back in 2012. So keep in mind that age is even though it's only 15% of your score, there's about 80-something points sitting there. So to some degree, you can't really do anything to increase that unless you get an authorized user to add you onto a credit card. And if you got like a friend or a parent, family member who's got a card that's 20 years old, that can really help a bit. Okay, Johnson, you are very welcome. Glad that helped. Scott, if you want to get more granular with that, just let me know. All right, so let's talk about inquiries a little bit. One of the things that I want to point out, this is just part of credit repair. This is just part of the process of people wanting to address things on their credit report for a better score. People obsess about inquiries to the degree where it's kind of comical. And let me show you what I mean. I'm going to put a FICO chart up on the screen here. There we go. All right, I'll scoot over this way. And I don't know if you can see my cursor on the screen. I don't think you can. Okay, so here's what we're going to do. This is a FICO chart. Vantage is not a lot different. And what you're going to see in this, hold on, let me see if I can do it this way. All right, this is not going to work. I'm not one of these guys that can do this well. Okay, here we go. All right, payment history, 35% of your score. Amounts owed, 30%. Now let's go around the wheel here. Length of history. This is what I was just talking about, Scott. 15%. Types of credit, also called credit mix, 10%. New credit, 10%. Okay, I want to focus on this for a second. New credit. Notice it does not say inquiries. Okay, it doesn't say inquiries because inquiries are not 10% of your credit score. It's in the category that's 10%. You have other things like how many accounts did you get? What kind of accounts are they? Inquiries is certainly a part of it, but it's not a big part of your score. It is factually accurate that an inquiry may reduce your credit score, but it doesn't always reduce your credit score. Okay. In addition to that, depending on what you have on your credit report, So somebody like myself, now that my scores are up in the mid high 700s, it just depends on what my utilization rate is. If I got an inquiry, like for example, I bought my car back in November, there was no effect, zero on my credit score whatsoever. Okay, and if there was any kind of effect, or if there had been, it wouldn't have been from the inquiry. It would have probably been from one of my data furnishers updating something, probably having to do with utilization rate. Utilization rate is especially when people are seeing swings on their credit score. 25 is 25 points, report over report, month over month is normal score migration. But everybody has this obsession with inquiry. So a couple more things about inquiries. I'm going to let this one go. One is VantageScore and FICO deal with inquiries slightly differently. What I mean by that is when you are shopping, let's say you're car shopping, Johnson, let's just say I know you got an approval. And in fact, this is very, very poignant to what you and I were talking about just now. If you are shopping, FICO and Vantage both understand what you're doing when you have multiple inquiries in a short period of time in the same industry. You're getting a car loan from Capital One. Okay, an auto loan has a certain code that is going to be submitted with that application so that FICO and Vantage both know that you are rate shopping. When that car dealership runs your credit, that's also coded with an auto FICO inquiry or an auto inquiry. So FICO in this example understands that you could have your credit run 2, 3, 5, 10 times as long as it all takes place within 45 days in the same industry. It's counted as one inquiry. So if you got a bunch of inquiries, and Johnson, this one is addressed specifically to you. If you had 2 or 3 or 5 inquiries, I'm not saying that you do, but let's just say that's what happens. Those are all one inquiry. If you have an impact on your credit score from the inquiry, which is not a guarantee, it would only be for one inquiry. Okay, now Vantage is a little bit different. Vantage calculates any inquiries. They don't have to be in the same industry. So you could shop for a car, you could shop for a home. Don't do that. Your mortgage broker would kill you. Credit card. You can do all that within 14 days. It doesn't matter. And Vantage considers all the inquiries in 14 days to be one inquiry. Okay, so I just want to clarify that about inquiries. They're not the boogeymen. Nobody's ever died from an inquiry. They're mostly benign. Okay, let's see. Scotty with another question. I used one of my credit cards to make a large purchase. It was about 2/3 of its limit, but I have about 10 cards with zero balance, and I got an alert from Credit Karma and Experian that Experian score dropped 92 points. So I went under the changes. Let me put that back up again. And only thing showing was increase of balance on that one card. Am I missing something? That's a big drop for just one card. 92 points. I'd look at my credit report if I were you, Scotty, and see if there's anything else. 2/3. Now, is it your biggest card? Like, for example, are we talking about a card that's got a $10,000 limit? You charged $6,000, $6,500, and the rest of your cards are like $300 cards. I mean, that's a possibility. Remember, credit utilization is a very sensitive subject. And the reason why credit utilization is a sensitive subject is because it's an indication of high risk. And what I mean by that is one of the stats that both FICO and VantageScore know is that when people go through any kind of financial instability, one of the things that they do is they rely on credit cards. So there's this pattern of utilization going up like this on one or more cards. Usually you get punished a lot more if it's across several cards. But as that utilization goes up, FICO and Vantage are like, okay, we recognize this pattern. This is a problem. A lot of people who overutilize at some point, statistically speaking, go into default. Now, doesn't mean that's happening to you. You can fool FICO and Vantage both into thinking that you're going into default with a big spend. So I would check on your credit report, Scotty, see if there's anything else you can see. If that's really what it was, okay, if it was a 92-point drop because of the utilization, and there was no new accounts, you didn't open anything new, there's no new inquiries, there's nothing else, then it's a very reasonable expectation that once that balance is paid, the score is going to swing back up right where it used to be. So I don't think there's anything to worry about. I think that's just a very exaggerated response for an overutilization. Tracy, thank you so much for the question. How do I pay my debt off? I only have $5,000 worth of debt. Well, $2,500. Okay, I'll answer yours, Tracy. I'll get over to Scotty. Okay. Tracy, you know, that's really a question that's outside of my area of expertise. You know, you certainly don't want to make minimum payments. Are we talking about credit card debt? Are we talking about installment debt? Are we talking about student loan debt? You know, I would need a lot more information. And even if I had it, I don't know that I would be able to confidently tell you this is a strategy for paying off debt. I'm a credit expert, specifically a consumer credit expert. I will do everything that I can, but I need some more specifics. Scotty, $2,500 limit, $1,800 purchase. Okay, yeah, so that's I mean, yeah, I mean that could do it. What you'd have to look at, what limits do you have on your other cards? What is the aggregate amount of credit that you have, meaning the limits all combined, versus the balance that you have? So when you go over that 30%, actually 20%, you can start seeing a drop in score. Depending on what your score is, depending if you have, and this is another variable, if you have other negative information that's on your credit report and you see climbing utilization rates, that can freak out FICO and Vantage. So like, uh-oh, this Scotty guy, he's starting to really overutilize his credit cards. Maybe there's something going wrong with his money situation, because we see he's got, I'm not saying you got this, Scotty, I don't know. But let's just, as an example, let's just say you've got some old collections or maybe an old charge off or something like that. That's going to be a big red flag. Vantage and FICO are like, oh, shoot, is Scotty going through default again? Is this going to be a repeat of what happened 2, 3, 5 years ago? And they can adjust accordingly. They can drop that score because of that. Okay. Tracy, but I don't use credit cards. Okay. Maybe is it student loan debt? Is it installment debt? I need a little bit more info. Awesome. Good to hear. You're welcome, Scotty. Okay. Credit card debt. You know, I had a recent conversation with a good friend of mine who is in about $20,000 of credit card debt. Right now, she is servicing the interest of that debt, which is, I think, about $800 a month. I mean, it's outrageous. And just so you understand, minimum payments on a credit card is, I think, 27 years to pay off. So it's worse than a mortgage. Credit card debt obviously is not the kind of debt that you want to get into. Are your credit scores good enough? Here's what I would do. Obviously, you want to start with the highest balance or highest interest rate first, and just knock that one down by itself as fast as you can. If your scores are good enough, I would look at doing a balance transfer. Okay, so Tracy, collections. Does that mean you have collections on your credit report? Because if that's the case, a balance transfer card is probably not going to be in the future for you anytime soon. It depends. Like, I would try to do a personal loan, maybe a collateralized loan. If you can get one from a bank, the best would be like a 12-month interest-free balance transfer on a credit card. I know a lot of people have done that. If you're disciplined, you can pay that off in 12 months. But that's really what you're looking to do. Patrice, hi David. Does your credit score go up once a bankruptcy is discharged on the credit report? It can. Yeah. What happens in that case, when you file bankruptcy, when that is discharged, all of your debt is gone. So if debt was a heavy component to your credit score, it's very normal for scores to increase once you file bankruptcy. Now, having said that, as long as I've been in the credit repair space, I've said this thousands and thousands of times. My favorite clients back when I worked for the previous company where we did full service, hands-on credit repair, which you don't need anymore with Creditversio. Creditversio replaces all of that. One of my favorite clients to work with was a bankruptcy client for a couple of reasons. One is all the debt's been wiped out. All the creditors have been eliminated in bankruptcy. So when you go to dispute those accounts, a lot of times the data furnishers / creditors, they don't want to reply to these disputes because there's nothing in it for them. They just got wiped out in bankruptcy. Why are they going to spend time, energy, and money responding to a well-crafted dispute, which is what Creditversio will walk you through? And what happens a lot of times, again, don't hold me to this. This isn't a guarantee. I don't have a crystal ball, but what I've seen happen a lot is a lot of those accounts that were included in bankruptcy get wiped off of your credit report. It helps a little bit. In addition to that, one of the expectations that I always tell people, or I give people to make sure that they have a realistic expectation, is that when you dispute your bankruptcy, first of all, this is not like disputing a credit card or a collection or something like that. Bankruptcies are hard to get rid of. Okay, if you do things on the up and up, now there's other tricks and things like that where you can game the system. You could probably do a YouTube search, and there's a ton of people on there that'll show you how to manipulate the system to work off your bankruptcies. I have mixed feelings on that, so I'm not going to really touch into it. I'll let you do your own due diligence. Now, with Creditversio, if there's an error on the bankruptcy, if there's a problem, and these happens, we do see bankruptcies get deleted. Does it come off of all three bureaus? Rarely. TransUnion, probably not too hard. Experian, happens. Equifax, rough. The bureaus are separate. They do their own individual investigations. Now, having said that, especially to you, Patrice, it's okay. Bankruptcy, it is easier to recover credit-wise having filed bankruptcy than having bad credit and not having filed bankruptcy. The reason for that is when you file bankruptcy, you sometimes get that score bump like you asked about. You have no more debt. You can't file bankruptcy again for another, I think it's 10 years. So now creditors are more than willing to offer you credit. You can rebuild smartly. And what I've seen this, I don't know, maybe 1,000 times in my career over the last almost 9 years. I have seen people with bankruptcies on their credit reports with credit scores in the high sevens. In fact, my old business partner filed bankruptcy, had an older bankruptcy. It was about 5-6 years old, had credit scores in the mid and high sevens within 12 to 18 months. Now, the reason for that is bankruptcy is one of those rights that everybody has. If you dive too deep in there, you can manage the bankruptcy. You can build credit from scratch, and you can recover. Okay, hold on one second here. Let's see. Okay, perfect. So don't be afraid of the bankruptcy. It's not the end of the world. You're more than able to recover from it. Okay, Patrice, another question. Yes, I've already rebuilt. While in bankruptcy, my credit score is 720. See, awesome. How long ago was your bankruptcy? So if it was a couple of years ago, you're going to recover nicely. All right, perfect. So the last thing I'm going to talk about, let's see how we're doing on time. Okay, we're 45 minutes. So let me see if I can get this last question out here. Okay. So this next one is going to be a relatively short one. Paying a collection versus disputing a collection. Okay. Tracy, I need repair. That's what Creditversio is for. It's a free platform. The only thing you're going to pay for is a Smart Credit or Identity IQ account. If you already have an Identity IQ 3-bureau account, you can link it. Creditversio is free to use. And it will do the exact same thing a premium credit repair company will do. And you don't have to pay anybody except for a 3-bureau credit report. Just get the one for $19.95 from Smart Credit. You don't need any of the other ones. Just go cheap. It's fine. Creditversio doesn't care. Okay. the question I was going to finish up with, paying a collection account versus disputing a collection. My position, and this is just an ethical one, is if you owe the money, you should pay it. Now, having said that, one of the reasons why the Fair Debt Collection Practices Act exists is so that you don't pay a collection that you don't owe, you don't pay a balance that you don't owe, and you don't pay a collection company who isn't legally entitled to collect the debt from you. So dispute it. Credit Versio knows how, even if you don't have Credit Versio, you can download a simple template letter from the CFPB, the FTC on how to dispute a collection account. Now, does paying the collection hurt your score? No, it doesn't do anything to your score unless you're looking at maybe a FICO Model 9, FICO Model 10, which, by the way, nobody's using that yet. These are brand new scoring models. They're not popular yet. We refer to these as contemporary scoring models. Now, when it comes to VantageScore, new Vantage scores, Vantage 4.0, 3.0, 4.0, this is what we're using right now, what you're seeing right now. Those ignore paid collections. So you could see a bump in your score if you pay off a collection on the contemporary Vantage scores and contemporary FICO scores. But if in doubt, if you're not sure, if you want to exercise your right, dispute a collection. Nothing bad can come from disputing collections. People think, well, am I going to re-age it? No, disputing doesn't re-age a collection. Making a payment, a partial payment, can re-age it. Paying it in full will not. Disputing it will not. Okay, thank you so much for joining me today. I'm going to jump off here. Can't believe that we're almost 50 minutes into the call. Covered a lot of information. Does anybody else have another question that I can answer for you before I jump off? Going once, going twice. I know it's going to be probably Scotty that's going to jump in last minute. If not, if you're watching this video replay, and by the way, understand we get most of the views for these videos when they're not live. So if you're watching this at 2 o'clock in the morning, this is not live. You don't need to blow up the comment section with why am I not answering your question. It's because it's a replay. I get that almost every single day. And if you do have a question, absolutely, I will answer it. I go through these. I keep an eye on them every day, and I'm happy to answer whatever questions are asked. Thank you so much for joining me today. I will see you next Wednesday, and next Wednesday, we will have John Olsheimer back with us. So if you have some questions that we want to go in depth with, he's more than happy to answer them. Thanks again for joining me, and have a great rest of the week. Take care.